morning, everybody. Thanks for joining in, and hope some of you would have had an opportunity to be part of the earlier sessions where we covered basics of P&L balance sheet, and subsequently the we also covered the ratios and how ratio analysis actually is a very powerful tool to actually drive the business and measure business performance. Now, in this session, we take it to the next level, which is more about planning and forecasting. So when we say planning over here, when we say business planning, we actually mean both the planning of the business as well as planning of the financials as well, which means the financial impact of the business plans and strategies, because looking at one in isolation is of no use. The business aspects have to be considered and translated into financials, and that is the only way we can have a meaningful impact in the business eventually. So why financial planning and forecasting? So that's what we'll discuss to start with. So first and foremost, forecasting, when we say forecasting, forecasting is actually a very systematic way of estimating future events. That means we have something going on today, but based on what we see at this point of time, we kind of use a binocular to say, okay, this is what it is likely to look like if things go as per plan. So the forecasts are based on certain assumptions, and it is also based on some historical data and also based on some futuristic data that is available. So it's a combination of all of that. And why is financial forecasting and planning important? Because primarily, one, it makes it very effective, because the whole thing is very scientific and well thought through, and you are seeing the pros and cons, the business, the financials, various angles are being looked at.
इसमें ये लिंक दिया हुआ
Yeah, so thank you. So that way the planning makes it very effective. It is good for the business, and it gives a certain direction to the business. The second piece is reducing uncertainty. And why do we say reducing uncertainty? Because when we do a forecast, we are actually looking at past performance, future, trends and things like that. And when we do that, we have already done a lot of homework and planning in the process. And when we do that, we are kind of anticipating certain things. So you're reducing uncertainty to that extent, because you're already thinking through. You're actually thinking through in terms of both pros and cons. If it works, then what do we do? If it doesn't work, I have a plan B. This is what I will do. And this is the impact of something not happening. So you're basically reducing uncertainty, because this whole thing is not inside the head. It is on paper. You're looking at it. The numbers are telling you a certain story, and that's where it makes a difference. Thinking ahead, obviously directly connected to both the planning and the uncertainty. But the difference here is this whole process forces the entire team to actually think much ahead in time. And when I say thinking ahead, there are two angles to it. So let me just touch upon a few things at this point. On the one hand, we have a budget. On the other hand, we say it's something called a plan. Then we have introduced something called a forecast. So what are these three? And how are they different from each other? Because often what I've noticed is, people use it interchangeably, but actually there is a subtle difference in each of these. Budget the intent of a budget is also the same set of numbers. The formats will be very similar, but the difference is budget is more like a, it's more like a control exercise. So you set a budget, this is what I will spend, this is what I will, this is the kind of revenue I'll get. Therefore, this is what I will spend. So you put a certain budget and I'm not going to exceed that, that kind of a thing. But when you say planning, planning is more about, it's a combination of both the business factors as well as the financial factors. And I will come to it in a little more detail in subsequent slides. So in the planning process, the business angles are considered, the financial angles are considered, and budgets are typically for a quarter or for a year, mostly for a quarter or a year. But a plan is more about giving a direction to the business itself, which means you are saying, okay, today I'm at point A, I'm a 20 crore company, and I want to become 3x, let's say in 3 years' time. So if I have to go to 60 crores, what do I need to do to get there? And if I have figured out these are the 5 things I'm going to do and I'll get to 60 crores, what is the impact on financials? That is what is a plan. So it is not restricted to 1 year, it goes beyond 1 year, it can go up to 4 or 5 years as well, so that you're thinking ahead, as we were speaking earlier. So at the same time, a budget could be a subset of a plan. So when you say you do a plan, you do it for 5 years, the first year could be actually the budget, because you are now very fixated on a certain set of numbers, and it is in a reasonably quick time frame of 1 year. So you have much more visibility on what is possible, what is not possible, etc. The third piece now is the forecasting. And what is forecasting? Forecasting is actually trying to level set. We put a budget and a plan, but then in reality, something else is happening. Or maybe it is working as per plan. That is also possible. But for a minute, let us take the example of something not going as per plan. So basically, it means is we were thinking that we will do 20 crore this year, let's say, and we are actually running at 10 crore. So what does that mean? That means both your budgets and plans have gone haywire. What does forecasting do? Forecasting says, okay, my budget was this much and plan was this much, 20 crores, but I'm actually running at 10 crores. So your forecast will say I'm going to hit 10 crores only. But the benefit of forecasting is you start revising all the other numbers as well. So you revise the revenue number, and then you start revising all the other numbers as well, so that you don't have a situation where you are instead of 20 crores, you're going to 10 crores, but your expense structure is for 20 crores. Then you are going to be in very serious trouble. And that is the benefit of both planning and forecasting, because when you combine these concepts together, it gives you total control over the business. And that's what the objective of this whole thing is. And which brings me to the next point, which is the managerial control. By doing all these things, the planning and the reducing the uncertainty, the thinking ahead, you bring a lot more control into the business, and therefore you are able to control the cost. And then you say, okay, if I'm going to do only 10 crores instead of 20 crores, whatever happened, let's say it's pandemic or whatever that is, then obviously you don't need to have as much inventory. So you have to reduce the levels of inventory. You have to reduce the levels of expenses. So you scale back on some of those things so that your adverse impact to the business is largely mitigated. If it may not completely go away, the challenges, but at least if, let's say, you were ending up with a profit of, let's say 2 crores instead of 4 crores, at least that is better than going into a loss situation. So that's the benefit of this whole planning and forecasting process. And why business planning? Some of it we actually already covered. Let me do a quick recap of that. It helps in estimating business activity. So you get a grip over, how the business is moving and what is the impact of all that on the financials. We spoke about planning. We spoke about management. Span of control, that's an interesting point because that that is kind of connected to the uh, cost and control, etc. Because if you had planned for a revenue of 20 crores and you're going to do 10 crores, then what are you going to do about the people? What is it they are going to do? How many people do you need? So that becomes a question mark. This whole exercise helps in driving business objectives because when you are doing a plan, the plan is about setting your business objectives. Obviously, you have certain goals in mind, 20 crore to 40 crores, let's say. So if that is the kind of goal you are having, this kind of planning helps set the pace for the business. It helps you drive growth because your strategies, if you have growth strategies, all those strategies are actually put on paper now, and then you have a way of calibrating and seeing whether it's really working or not. By doing all this, your entire organization gets aligned to this, so all your senior leaders are aware of what the plan is and why you are doing what you are doing. Once people are aligned to it, there's a lot more acceptance in terms of what initiatives need to be taken, what proactive steps need to be taken, etc. Now, what are the factors that impact forecast? So when we do a forecast, it's a to start with, it's a business forecasting exercise. So there are internal factors and there are external factors. The internal factors actually take into account all the historical data pertaining to the performance of the business. So how you have performed both on revenue, cost, and profits from that perspective over, let's say, the last 2-3 years. Based on your resources that you have and the kind of business you are projecting, what kind of procurement you need to do in terms of material, how much labor you need to carry, how much financial resources you need to have, what kind of capital requirements are there. You can't just grow 20 to 40 crores if you're already at full capacity. So what does it mean from a capex perspective? So these are the things that get taken into consideration when this is not just actually, though I've said factors impacting forecast, these are factors which impact not just the forecast, they impact the budget, the plan, and the forecast. Then from an external perspective, things to watch out for. Not all of that can be controlled or estimated, but definitely businesses need to be aware of it so that if there are certain steps to be taken or if your projections need to be moderated to take into account, let's say, for example, let's say the economy is going through a downturn. There is no point trying to put a very aggressive growth in the business plan because unless there is a good reason for it, it would be risky to do that because then you are assuming something big is going to happen, whereas your cost structure is remaining at the same level. And then it impacts your business very adversely from a financial perspective. Therefore, all these things become important. Political stability is at a very, very macro level. Government restrictions are very, very important because let's say simple things like you need raw material to be imported from China to manufacture certain components or something that goes into the manufacture of a certain finished product. If the government is putting restrictions on import from China, it is going to impact business. So what are the risk mitigation initiatives to be taken? What are you going to do about it? So those are things, and what is the financial impact of all that? Those things need to be considered because otherwise business is not really going to happen. Fiscal and monetary policy impacts your ability to uh, get capital. So whether banks will lend or not, those kind of things get impacted by fiscal and monetary policy. So one doesn't really need to understand the entire policy per se, but it is more about understanding from a banking perspective, etc., how it is going to impact your business. Price level trend is very important. Now, for example, competition is, let's say, dropping prices. What should you do about it? Should you keep this price at the same level, or should you also consider dropping your price so that you don't lose market share, you don't lose customers? Those are things that are very important, need consideration, because it is going to have an impact on the business. Technological R&D, what is happening with respect to competition? Are they putting superior R&D and superior technology on the products? Is it going to change the way customers are going to perceive your product or service? Or are you taking a leap of faith and investing in R&D to really lift your product to a very different level? So what does it mean from a cost perspective? How do you build it into your P&L? Those are the kind of important considerations one need to keep in mind. Export potential, obviously, if there is an opportunity, the country has been witnessing solid export opportunities in recent times. I've heard, especially in the automotive space, the export potential has increased dramatically. So at least with some of the large companies, we are seeing dramatic increases in exports. So what does that mean to the business? So that is one thing. And not just that, what are the new opportunities that are presenting themselves? And how is your company going to take advantage of that? Then, of course, the general business environment, are there any other factors which don't really fall among the first six, which are going to have an impact on the business? Definitely need to be considered. So these are all the factors with respect to the business. So I'll just take a minute and pause before I move to the next slide. Any questions anybody has, I would be happy to take them. Jayat, are there any questions by any chance on the chat?
No
Jayat?
questions right now,
Okay.
Shekhar. We can continue.
Okay, fine. With that, I'll move on to how do we go about the process of forecasting. Now, this could be actually used interchangeably. This process can be used not just for forecasting, because the process is somewhat similar, though the extent of the exercise could vary. I mean, the effort that is involved, because at a budget and forecasting level, it is like grounds up, putting together everything. But when you do a forecast, it's more about recalibration as to where you stand. But essentially, all the various aspects have to be considered in all three. So what are those different aspects that need to be considered? So first of all, when you do a business plan, the first step is to develop growth strategies. How are you going to grow the business? There's no point having a financial plan and showing some 20% growth over the year on year and stuff like that, if you don't really have a game plan. So what are your growth strategies? If you're saying that I'm going to grow 25%, how is it going to happen? Which product is going to generate that additional revenue? Which target segment will generate that revenue? And why will they generate? Is there a need? Is there a business opportunity out there? Or is it just we are thinking in our mind, I want to do it? It's important to see both sides of the coin. The inside out view, which is like you want to grow, you have a certain goal in mind. And the outside in view, what is the customer expecting? What is the market willing to take? So both are very important. and find what is that sweet spot and go for it. So once the growth strategies, I'm not going to spend too much time on the growth strategies itself because that is a whole big session by itself. So I will just assume at this point, businesses know how to build their growth strategies. Once that is understood, what are the business assumptions? Like based on the growth strategy, how much let's say year-on-year revenue growth or quarter-on-quarter revenue growth, or let's say if it is an expense, how much annual increment, let's say for labor, how much additional labor is required. Those are the kind of assumptions. Then you could have financial factors as well. And I'll come to it in subsequent slides in somewhat greater detail. Estimate future trends. So if there are some technological changes happening in the market, those are things that need to be considered. So this is the outside in view perspective. Once all this is done, you have a let's say a budget for the first year, and you have a plan for let's say the next 3 years or 5 years. Now comes the next step. Meanwhile, business is continuing, you're doing your business. Actuals start coming. It's important to start seeing how the actuals measure with respect to the budget or the plan, because that is going to say how good your forecast or how good your plan was. Or it's possible that the plan was good, assumptions were good, but suddenly, meanwhile, certain things have happened in the market. And, the business assumptions that you had earlier are not quite valid at this point of time. That is when the forecast kicks into the picture. And in the forecast, you will recalibrate and say, okay, this is a new normal, this is the new things that are happening, and therefore, this is what it will look like going forward. In the process, what you're also doing is taking corrective action, because when you see all these things, you realize, okay, my business is not going to be 20 crores, let's say, it's going to be 10 crores. Then I have to scale back on my expenses. So that's a corrective action. The reverse is also possible. You thought your business is going to be 20 crores, but business opportunity is showing that there is a far bigger opportunity out there. And if you are targeting only 20 crores, then you are leaving business on the table. So why not go for the 30? So what is it you need to do to get to the 30? What are the 5 things that need to be done to get to the 30? Lay it out very carefully. Find out what is the impact on financials, put it in the numbers, and show it in the form of a P&L, balance sheet, and cash flow. That will give you a complete structure and a defined way of looking at the numbers and a consistent way of looking at the numbers. Otherwise, it's all in the mind. One is thinking this is happening, this is the impact. But actually, when you put it on paper, it starts looking very different. So this is a very standard, best-in-class approach to business planning and forecasting. Just from the next 3 slides are basically, these are basically templates that I'm sharing with, so that you get a sense for when I'm saying you build a plan, focus, what will it look like? So let me start with the assumptions. So you say, this is just an example, this could vary from company to company, but by and large, these are pretty much standard with possibly some changes or some adjustments to the format, but pretty much standard in most ways. So if you look at sales, maybe it is export sales and domestic sales, or some companies may be a little more sophisticated and say, I want to see sales from a segment perspective. So I am selling to the automotive segment. I am selling to the aerospace segment. So how much is going to come from automotive? How much is going to come from, let's say, aerospace? That kind of differentiation is very powerful. The reason being, the growth opportunity in each of these could be very different. So when you put it into a format and start looking at it in a very structured way, it starts showing many different things that you are not thought of before. So when you do that, you say how many units, what is your pricing per unit on an average, and if let's say it's between export and domestic, you split it out in that fashion, or you could split it out by segment. There are different ways of doing that, but broadly the approach will be something similar. Now, if we come to the okay, one aspect I probably have missed out here is the impact of that on the cost of goods. So that is another piece that needs to be captured. So if you're doing this much sales, what is the cost associated with it? Material cost associated with it? What is the conversion cost associated with it? So that also should be put into the forecast and captured, so that it very clearly lays out what are your assumptions. When you said you will do a certain level of business, what all assumptions did you put in? So it helps you capture all that and put that in one place. Then comes the expenses piece, which you see on the right side. So this is more like a headcount plan. So you kind of this kind of shows you what is the forecast for the next 4 quarters, and therefore for the full year. First quarter, so say April, May, June. Second quarter, July, August, September. Then likewise the next 2 quarters, and all the 4 quarters put together is 2022. That is, which is the March 2022, which is the full year. And here also, if you see, we also have a line which talks about salary year-on-year increment, etc. So that also is captured over here to ensure that you're not understating your expenses. Then you put in certain salaries, etc. And so it's a very structured approach to what your real cost is going to be. Now, another set of forecasting assumptions is on the balance sheet side. So far, we had looked at the P&L side. And of course, you have the expenses as well. So you saw salaries. Apart from that, you will have other expenses like, routine maintenance, etc. Those also you have to decide, is it going to be, so how do you estimate that? It could be, you may use last year's numbers, or if you think that you're going to spend only that much. But let's say if you think you're going to grow the business from say 20 crore to 40 crore, then obviously all these expenses are going to go up. So one way of doing it is, let's say last year your maintenance expenses, let's say they were, let's say 2% of the total revenue. Maybe you can keep that, if you think that is reasonable, then you can apply 2% of revenue for the budget or the plan as well. Because if your revenue goes up, your 2% of revenue will obviously be higher than last year, but it takes a certain increase into account based on past trends. So with that, you will have all the expenses. Now, if you come to the balance sheet, you may have to, as we discussed earlier, you may have to add more machinery, add more capacity to do that additional business. And that's where you capture how much additional capex you need to add in the form of plant and machinery or any other assets. It could be land and building, it could be anything else. So what are those things? Put in all those things. Other assumptions are like corporate tax rate. Of course, corporate tax rate actually goes and impacts the P&L. But apart from that, you have cost of debt, secured, unsecured, basically. This piece should have gone into the P&L. So these assumptions, so income tax and cost of debt, which is the interest cost, these actually go into the P&L. Then you have the financing cost. So are you going to put equity, more of personal money, or are you going to put more of debt? And each of that has a different impact on the financial. If you put your personal money, there is no interest as such. But if you are going to take additional bank borrowings or or any other unsecured borrowings from other people, then in that case, there will be an impact on the interest. So that will have an impact. But this is something which will impact your capital structure, and something you have to figure out how much of it you need, how much capital equity infusion you require. This number is actually a factor of, it's actually an iterative, sorry, it's actually a iterative process, because when we do the P&L, balance sheet and cash flow, when you see a cash deficit, that cash deficit becomes your financing requirement, because obviously you don't want to be in a cash deficit situation. So if you want to make sure there is no cash deficit, that means you need to have either equity or debt, so that you have adequate cash to run the business. So that's an iterative process, but eventually that will come over here as part of the assumption, but as part of an iterative process. Likewise, you might have other, if you're taking debt, for example, if it is secured debt, now I'm on this section, the right section, then you have to see how much is the existing debt, how much more you are likely to add. Likewise, on unsecured, how much you are having now, how much are you likely to add, and what is the impact of that from an interest perspective. So those are some of the things. Then you come to working capital. Now, when you are talking about working capital, you are basically talking receivables, inventories and payables. So what level of inventory do you need? How much inventory do you need? How much of receivables will you have? So for example, the way to put an assumption over there would be, for example, I'm carrying 3 months of inventory. That could be an assumption. So if you say 3 months of inventory, which translates to on an annual turnover, if you say 3 months, it is basically 25%. So if you're doing, let's say 40 crore revenue, that means you should carry an inventory of 10 crores. So that is how that translates. Similarly, you will have receivables. If your receivable pattern is, let's say you collect within a month, so 1/12, which is about 8%. 8% of the revenue is what your assumption. So if your revenue is 40 crores, 1 month revenue would be about what is that? About 3 crores, roughly a little over 3 crores or so. So that's how those assumptions work. And liabilities very similarly in terms of your purchases. Let's say you have 1 month of purchase, or let's say you have credit of 2 months purchase. That's what you will put. So all these things that we did on the balance sheet, they become part of your balance sheet, and these assumptions actually get eventually captured in the balance sheet. Now that all the assumptions are done, what does a sample P&L forecast template look like? So what will it look like? So let's say we are looking at a time frame of 2019 to 2022. And let's say we have a situation, 2019 is audited. It's a hypothetical situation. 2019 is audited. So you take the 2000 actuals over here. So this is not a plan or budget or focus. This is actual. Audited 2020 because this is already done, audited numbers. Then you have estimated 2021. So when we say estimate, it could be your budget or part of your plan. Let's say you have made a budget for the current year, and suppose it is part of a plan for 3 years, first year being the budget for the current year. This may actually not be the budget. So this will be more like the forecast. So at this point of time, depending on when you do it, if you are in the beginning of the year, this becomes the budget. For 2021, this will be the budget itself because you are doing it in the beginning of the year. But let's say if you're going through this exercise in the middle of the year, let's say 6 months have passed. So you're already in September. So now you're estimating for 2021. Then what you would do is you take the actuals from April to September and estimate it for the rest of the year. And that is precisely what is called a forecast, because you take real factors into consideration and say, okay, this is what I've already achieved and this much more I'm planning to achieve based on the latest current circumstances. That is what is called a forecast. So in this case, that would become a forecast for 2021. And these also would become a forecast Q1, Q2, Q3, Q4. And it becomes a, I'm sorry, I take back. When I say estimated 2021, it is March 2021. The reason I said estimated is because it is, year is over, March 21 is over, but the reason you call it estimated is unaudited. If it is audited, you would put it as audited 2021. Since it is not audited, you say estimated. But for Q1, Q2, Q3, Q4 of 2022, which is for the year ended March 2022, let's say first 2 quarters are actuals. So those actually become, you will take actuals over there. Q3 and Q4 will become a forecast. Then the whole year becomes the forecast for 2022. And likewise, you may do something similar for the future years. Then you can add the future years also to it, so that you have a 3-year picture. Let's say you want it up to 2025, you can have it. So that's what a sample P&L forecast looks like. And the good thing about it is, just like any P&L, very structured. And here, what you can very clearly make out, for example, is when you put all the assumptions in the previous sheets and brought it over here, what is your year-on-year growth looking like? What is your quarter-on-quarter growth looking like? Is it making sense? Is it even doable? Not doable? Is it aggressive? Or is it it is not at all aggressive and you can do a lot more? Those are the questions that you ask yourself. And likewise, it goes for the direct expenses, which is the material cost, labor, etc. And a very important part of this whole thing is this gross margin line, because this is something you have to be watching out for very closely, because clearly this is what is going to be the driver of your business. The gross margins, the difference between your revenue and material cost plus conversion cost. In other words, we call it the cost of goods sold. So the margin of cost of goods sold is basically, margin of the gross margin is basically the direct expenses, or in other words, cost of goods sold divided by the total revenue. So one has to keep watching out for this and make sure it is moving in the desired direction. And if not, what are the actions that are to be taken to actually shore up the gross margins? Because these are all variable costs and something that you can work with your vendors, or you can enhance your product to generate better margins. So those are things you can do. And then, of course, we have the expenses, finance costs, depreciation, etc. So this is what a sample P&L looks like. Let's see what a sample balance sheet looks like. Very similar. Audited, estimated. Then for the current year, it is like a forecast. Current year, which means year ended March 2022. So when you took all those assumptions, it basically tells you how your balance sheet is looking like, because you took assumptions of, let's say, depending on how your P&L was looking, you decided to put either share capital, or let's say you wanted to go for short-term borrowings or on working capital. So all that got captured. Likewise, you had assumptions on fixed assets, that also got captured. On current assets, you had inventories and receivables, that also has got captured. So you have pretty much captured everything. Now you have the balance sheet as well. So you have covered all the aspects of the business, the ones which are directly impacting your P&L, and the others which are possibly in some way interacting the P&L, but also showing up on the balance sheet, like the inventories, receivables, borrowings, etc. Now you have both P&L and balance sheet, and we spoke in the last session how the balance sheet and P&L are connected to the cash flow. So when you do both of these, you get the cash flow. So just to do a quick recap, it has three sections basically: cash flow from operations, cash flow from investing activities, cash flow from financing activities, and then you have the opening and closing cash flow. So this gets created, and the important thing to understand from this, once you have done this forecast and you have the cash flow forecast in front of you, what is it you look for in this? You have the numbers. P&L, you can make out whether your revenue is growing or not, whether your profit is growing or not. So those are things you can understand and do some iterations. Balance sheet also, days of inventory, days of receivable, days of payables, all those things, again, you can tweak and decide whether you can do something about it to improve it or otherwise. Now, ultimately, the crux of this whole thing is to see what does all that do to your cash flow. Ultimately, this is where the rubber meets the road. So it really becomes important. What is your cash flow from operations, let's say? Let's take, for example, audited 2020 to estimated 2021. Net cash flow increased from 4 to 14. And this is net cash flow from operations, which means in terms of actually doing business. That means the buying and selling aspect of the P&L impact of doing business moved from 4 to 14. Whereas it had come down from the previous year in 2019, from 12, it came down to 4. So these are things that you have to keep in mind when you do a forecast. Are you able to predict a favorable trend or not? Is 14 becoming 18, 20, or whatever that number is? And is that a good enough number? That is also important. Or let's say the business conditions have become really bad and the 14 is now become, let's say, 6 or something. Is that, what does that do to you? Does it disrupt your operations? Do you need to do something else to stay afloat? Those are the kind of questions that come up when you actually come to this template. The other piece is the investing activities and financing activities, the cash flow arising out of investment in fixed assets or investments. The financing activities is about funding or equity, depending on whichever one is taken. So if you are running, let's say after doing all this, you have a closing cash balance which is negative, you have a problem. You can't have a closing cash balance negative because that means you are in trouble. You are not able to pay off your debt, your vendors, etc. And that is a challenge. So you have to figure out how you still become a favorable cash balance, not just zero, but it should be significantly favorable. And what is it you need to do? And let's say if business is bad and there are limited things that you can do, then maybe the solution is to take either more debt or obviously infusing more equity if you have it, or dilute your equity, get some other partner into the business and infuse some equity so that you have the business going and you have cash to run the business. So this is how this whole process helps in structuring the business and driving the business in a certain direction, and also capturing whether it is working or not. So what do you look for in the forecast effectively at the end of it? So some of it I captured just now. Does the forecast look realistic? Is it making sense? Because forecast can't be a just number crunching exercise. I like this number, so I put the number. No, it has no meaning. So is it realistic? Will you be able to do it? Because if it is not, then it's a waste of time. So, so that is the first question. The second question is, does it reflect your business strategy? Do you have a game plan? If you have a game plan, is it a reflection of that or not? Let's say you have a certain strategy, but here that is not taken into consideration. That means your operations is moving in a certain line and your financial forecast is moving in a different line. Then the two will never meet. That doesn't make sense at all. The two have to go hand in hand. So that becomes very important. The alignment of senior management with the business strategies, with the financial plan, all tied in very closely together. The other question is, so you have a strategy, that's great. Next question is, will your business goals be attained? So you have a certain business strategy that I will chase this market, that customer, this vendor will give me material at a lower price, cost, etc. But after doing all these things, am I really achieving the goals? For example, if my goal is to grow 25% year on year, is that really happening or not? Or I want to improve from let's say one of the goals is one product which was a loss-making product has to become a profit-making. Is this a reflection of that? If it is a reflection of that, do you have a real game plan to do it? So just because we put it over there doesn't mean it's going to happen. There are 5 actions that, let's say, need to be taken to make it happen. If a product has to become positive, maybe the raw material cost is to be improved, or maybe there are a new feature set. There are new feature sets that you are adding, which will improve the price of the product, and therefore your realization increase, therefore your margins increase. So there may be 5 actions, let's say, related to that. So have you captured those 5 actions, and have those actions been considered in the forecast? So that takes me to the next logical question. What are the internal challenges in achieving the goal? So let's say you put all these things, capture the assumptions, the game plan, the action plan, everything is there. Is there a challenge in doing it? Because just putting it there is not enough. The people may not agree with it. They don't align with it. Or people agree, everybody is in agreement, but you don't have bank finance to do it. So how do you do it? So are there any financial constraints, operational constraints? So you go back, rework, and see where it lands. And then that is how a forecast works. You keep tweaking and getting better and better. And at some point, you will get mastery over it. So it could be both financial or operational or both. Most likely, it will be both. That's my experience in the last several years of my career. So again, what's the game plan to address these challenges? Who are the accountable owners? It can't be always that the CEO is taking ownership for everything. Yes, CEO has to take ownership, but if there are 5 action points over there, there might be 2 action points, let's say, for the finance guy. There may be 4 action points, let's say, for the operations team. Maybe it is somebody for manufacturing, some for, let's say, logistics, as an example. Then have we identified the owners and the actions? Becomes really critical. Having done so, all these are internal. What about the potential market risk? Are there any risks? Are we over enthusiastic, and have we ignored certain adverse market trends which can directly impact the business? Have we considered that? So that's something to look at. Are actuals reasonably in line with forecast? Now all that you have put, everything has happened, actuals start coming. So now the actuals are looking often very different, but that's okay as long as it is not very, very different, because it can never be perfect. And that's why we have something called a forecast. But difference of 5% is okay. Difference of 20% is meaningless. It's a waste of time. So it may happen in the beginning, in the early stages of this process, but over time, the mastery of that becomes very critical, because that is when as you get very minimal variations to the forecast or the plan, it shows that you're getting more and more mastery over the business. So I think with that, I have pretty much covered what I wanted to cover. Happy to take on questions. Jayat, over to you.
Yeah, I had one question before KP comes in. Is
Yeah.
that we hear these two terms, something you've covered today also about forecasting and budgeting, right?
Yeah.
And sometimes those terms are used congruently, sometimes disparately. So, can you just lay out in layman's terms what both these terms, how they differ from each other?
Sure. So budget and let's say we are talking about a 1 year time frame. A budget and plan are pretty much the same if you are looking at a 1 year time frame. If you go to a multi-year time frame, then first year becomes the budget and the subsequent years become part of a long-term plan. Now comes, and what is a budget? Budget is you set something for let's say a certain fixed period of time, and you tell everybody in the organization, look, this is our budget, this is our spend budget, and let's say this is all that we will spend, and we will stick to it. So you lay it out over there. Now, as I mentioned earlier, the forecast is a little different. When you say forecast, basically it is what you are trying to do is bring reality into the picture, because budget, you put it in the beginning of the year. You had a full meeting of the entire team. You said this year, this is our budget or plan, and this is what we want to achieve. You put the revenues, the costs, etc. 3 months pass by, first quarter passes by, and suddenly you realize that business is not going in the direction you wanted to grow. So while your budget was assuming 20% growth, or let's say 25% growth, which included revenue and costs, but the actual says that it is growing at only 10%. So forecast, what you will do is you will scale down the numbers. So both revenues comes down, because you're trying to be realistic. So you bring it down, and that means expense also comes down. That means you have to kind of limit your cost to that extent now. So in some senses, you could say it is like a revised, if you choose to contain the numbers, then it becomes like a revised budget, to say loosely. That is what, because your forecast is telling you that. Was it clear?
Yeah, Shekhar, that makes it clear. Yeah. KP, you are trying to say something?
No, I'm just probably asking some of our SMEs if they can actually share whether they actually get into annual budgeting exercise, they are doing it, how they are doing it. If not, what is it that they think that is difficult part of not doing it? If I can invite some thoughts from the SMEs in terms of first whether we are doing it or not. That's the first question probably for them.
Yeah, I think somebody has, Sanjay Shah has just responded that no budgeting exercise is being done.
Okay. Great.
Yeah, I would kind of agree with that, because I have been in this consulting profession for the last 4 years or so. And I would say a budget planning exercise, etc., most of them are not having, even up to 200 crore companies. I have not seen them doing it. In fact, it's very interesting. I will tell you, even a 1,000 crore company that I was consulting for didn't have that process.
Okay.
It's very surprising, because when we work with MNCs, this is a day in and day out kind of activity to have complete control over the business. So it was a maniacal exercise over there, and everybody used to be on it. But I'm not suggesting that we should have it like that with that level of intensity for SMEs, because they won't have the bandwidth or that amount of time to do it. But bare minimum, my recommendation would be at least have a budget process and budget and actuals to start with. Going to a forecast and 3-year plan is the next step. That's a more evolved step. But good companies with good fiscal prudence, really, I would recommend that at least budgets and actuals should be done. How is it very different from running a household budget? It is no different. Your business is like it's your business at the end of the day. Even for a salaried professional, they have consciously or unconsciously, they have budgets. They know that they can't spend, let's say, more than 30,000 rupees per month or whatever that number is. And why is that? Because they know that their cash flow will not allow them to spend more than that. Now, when you are in business, a lot more is at stake. It's not as simple as getting a salary and having some expenses. That is very easy to do. You can do it at the back of the envelope. That kind of an exercise cannot be done at the back end of at the back of the envelope kind of thing, because it's highly risky. Because you are having contracts with your bankers, your customers, your vendors, and your own business is at stake. So it's absolutely critical that some of these things are done so that you have a complete grip on the finances. Otherwise, when shocks come, it's very difficult to handle because, as I said earlier, covered in the first slide, uncertainty has not been taken into consideration.
Okay.
One has not looked ahead to capture that. So I would really advise, if you have not been doing, that's okay. But I would really advise the entrepreneurs to take a look at it. And budget can be done once in a year. And every quarter, take a look at it and see where it is going. And you will be surprised to see things that you were not aware of.